Happy Friday, everybody. I hope you like roller coasters because that is what we've been on over the last several weeks, even really several months, in fact, as we've been talking about this over and over and over. Rates are not going to go down in a straight line. And the last couple of weeks is certainly a great indication of that. What's frustrating is that we're not seeing more consistency as they should be, but they will be dropping. I mean, the last couple of weeks we've seen a really bad week, then we saw a really good week, followed by this week where we've seen some days that are good, some days that are bad. Yesterday was good. Woke up this morning, the market was not good to bonds and interest rates, but they have recovered throughout the day. So there's some volatility during the day, and we're continuing to see that, but it's a struggle off and on. We're seeing, technical numbers that are bouncing off the 200-day moving average. And basically, if you're looking at any chart, if you're looking at 10-year treasury, or you're looking at mortgage-backed securities, if you see that, you will see that the numbers are just bouncing off the 200-day moving average. We can't quite get past that. If we get past that, however, we should see market improvements in rates. But right now, until that is going to happen, we're going to be trading in this range. And unfortunately, that means 30-year mortgages are going to be bouncing between 6.5 and 7 and 8, kind of in that range. Government loans, government rates going to be in the low 6s, maybe upper 5s. Again, pay attention to points. So many banks, lenders out there, they're savvy. They understand what consumers don't understand, and that is, how much is it going to cost my interest rate? So many borrowers out there are being led astray on low interest rates, but they don't understand the cost of those interest rates. And we've talked about this over and over and over. We talk about it every day with our clients, with our partners, and everybody that we work with. So educate your clients on how interest rates work. Okay, not all interest rates are alike. Be careful of what you pay. And also think about, if you're going to refinance in the next 9, 12, 15 months ahead, you don't want to pay a lot of points. You don't want to pay a lot of fees when you're going to have to use some of that for closing costs down the road. So we have to look at the big picture. Don't be transactional. Let's be relational. Let's look at the big picture. That's kind of what we want to talk to our clients about. Now, housing data and home value data came out earlier today. Zillow, CoreLogic was showing, get this, that home values actually increased 1.4% in 1 month. Now think about that. We've been listening to the media. We've been listening to people on CNBC say, hey, the market's going to crash. It's Armageddon. Get out while you can. Don't be buying houses. They're all out there. They're everywhere. But they don't know what they're talking about. Again, because they're not understanding the fundamentals of the market. They don't understand inventory. They don't understand the things that you guys understand and what we see on a daily basis. And the reality is the housing market is healthy. Okay? But the macro part of the economy, as far as the job market and some of the other things that we're seeing in inflation, is creating a slow recession. We don't think the recession is going to be really, really bad, but it will be a recession, and we will see mortgage-backed securities respond to this in a way that will see rates slowly go down. Not as fast as we want, not in a fast line, and it's been frustrating the last couple of months, but next week, the new CPI report comes out. We're hoping to see some good positivity there in terms of the mortgage rates, but also inflation itself. We're hoping to see, again, all the things that the Feds have done over the last 6+ months should start taking effect on the CPI reports, the Consumer Price Index report that comes out each month for the next several months. We should start seeing some really good numbers this summer. And so, again, the timing hasn't been exactly what we wanted it to be, but the fundamentals are going to win the day in the end. So stay patient, be vigilant, and talk to us and how we can help you with your clients with objections to the housing market, because as we saw in the report today, people are missing out. If they're not buying homes right now, they're going to regret it tomorrow. Let's help you win, and have a great weekend.